Hello, everyone. Welcome back to Finance Friday on the ARCUK YouTube network. Hard Money Jim, back here in beautiful Jackson Hole, Wyoming for the summer, even though it's still only springtime here in the Rockies and there's plenty of snow still on the ground. I'll show you, let me share my screen here, and I'll show you something interesting. Speaking of snow. All right. That's my back porch here on March 13th. This is climate change taking place before our very eyes. Just kidding. We had so much snow here that we had to employ this gentleman and some of his associates to remove tons of snow from our roof and from our porch. Now that's about 9 feet of snow there. We had damage to the patio, unfortunately, and it's total, but the roof is good. So the other good news is the ski resorts and the skiers were very happy this year. Okay, well, today, let's talk about good and bad money creation. Bad money creation and inflation. And what I want to talk about in preview here is let's talk about the enduring inflation that's upon us. And then I'm going to tie that into the troubles at the American regional banks and our old theme of financial repression. And I'll try to connect the dots on all those three topics. So first, what I want to do is kind of parse the proper definition of inflation in order to get a good understanding of what inflation really is, its cause, what causes it, and what are the consequences of inflation. And I'm going to emphasize that contrary to many popular economists and pundits, inflation should not be defined as an increase in consumer prices. It's much more than that. Consumer prices are only just one important symptom of inflation, but there are others that are equally important and maybe more important. And second, then we're going to update the regional banking crisis in the USA, where depositors are continuing to pull out their money to invest in higher yielding government-related investments. And I'm going to emphasize there what I think is the real economic risk related to deposit flight from the banks. And as we'll see, the risk is not the loss of deposits per se, but the loss of these banks' ability to continue lending and funding the business activity that keeps the economy humming. And then finally, I'm going to connect inflation and bank lending to financial repression. That's the combination of inflation and low inflation-adjusted interest rates. Financial repression is upon us, and I think it's going to continue for years. Okay, so before we dive into our first topic of inflation, I want to pause and reflect on the importance of sound money, and to kind of motivate you. I mean, why do we care about inflation? All right, so here's the Consumer Price Index. It's calculated by the Bureau of Labor Statistics, and it shows a loss of purchasing power of the dollar over time. For example, according to this index, which I think understates the inflation problem, you need $300 today to buy what you could have bought in 1982 for $100. And the standard cluster of goods measured by this index costs 17% more today than it did just 3 years ago. Now, notice how the line starts to move upward more rapidly about 1970, early 1970s, when we went off the gold standard. And then it jumps again, during the early years of the 1980s inflation. And then it jumps up even stronger here during our most recent inflation related to the pandemic. Most of us, I think, take sound money for granted. And by sound money, I mean money that keeps its purchasing power over time. Now, whether you're spending money for personal consumption or long-term investment, Sound money is essential for assessing prices and planning your life. Accurate economic calculation, which depends on stable prices over time, permits people to do complex transactions over vast amounts of time and space with anyone who chooses to participate in the economy. It allows us to cooperate with millions of people we will never see, never know. And it allows us to concentrate on the one or two things that we do best and trade with money with those people. Sound money is obviously essential to an efficient division of labor. It's also essential in allowing each of us to be compensated fairly for the economic value that each of us chooses to offer in the worldwide marketplace. For example, if you buy a bicycle from China, think of all the people that you're cooperating with to get that thing manufactured and shipped to your home. There are millions of these people, and you don't involved in this transaction, and you don't even know them. But sound money, along with a profit motive and good commercial agreements backed by good law, are really all you need to incentivize someone to provide that bike. So it's no exaggeration to say that sound money is crucial for each of us to individually, and therefore it's in all our interests and in our national interests. Now, in thinking about this, it occurred to me that money creation is like industrial energy creation in some very crucial ways. Alex Epstein, who many of you know as the author of Fossil Future and the Moral Case for Fossil Fuels, very adeptly points out that reliable energy is crucial to human flourishing, as he puts it. In the same way, reliable money is crucial for human flourishing. This is not surprising when you notice what reliable energy and reliable money have in common. Money and industrial energy were both invented by humans, and humans can destroy both if we're not careful. Both money and energy are fundamental to economic progress and a rising standard of living because both allow their users to engage in wealth-generating activities. Money and energy are ubiquitous in a modern economy. Practically no important economic transaction can occur without reliable money and reliable energy. And of course, most important, money production and energy production are being threatened today by government interfering in their creation. And this must be opposed because private business can and should provide both the money and the energy needed to meet their most important functions. Now, as Alex has pointed out, most people take reliable energy production for granted until it's no longer reliable. Then they wake up and wonder what happened to their standard of living. I mean, just look at the energy poverty in the UK and on the European continent today. Similarly, we are today taking sound money for granted at the very time that it is becoming less and less sound. Just as most people don't know where their energy comes from, they don't know where their money comes from. That is, they don't know how it comes into existence. So ignorance of energy production has allowed many people, including influential politicians and bureaucrats, to embrace all kinds of anti-energy policies that threaten our well-being, even our very existence. And in just the same way, ignorance of money creation has permitted politicians and bureaucrats to enact policies and regulations that undermine our money, thereby threatening our ability to grow and prosper economically. That's why I have called money creation a black hole in the universe of economic knowledge. Practically no one understands it. And that's the big problem, because if you don't understand money creation, you can't understand its economic consequences, both good or bad. Now, these consequences are both fundamental and they're really colossal, but society has no clue how vital sound money is because they don't understand the money creation process. The level of social ignorance of money creation might even exceed that of energy production, the ignorance of energy production, if that is even conceivable. So that is why I have made explaining money creation and its consequences my central professional purpose. That's the purpose that I expect will keep me busy for a very long time. So today's discussion on inflation is just one more effort to understand this black hole. So forgive me that long introduction. So let's now explore inflation from the perspective of good money creation versus bad money creation, with an emphasis today on bad money creation and its consequences. Now, in preview, we'll see that sound money comes from sound investment decisions made by private commercial banks, resulting in positive, non-inflationary economic growth. But we're also going to see that government too often corrupts money creation, resulting in unsound money, giving rise to many dire consequences, including unwelcome increases in consumer prices, asset price bubbles, a waste of real wealth, unjust economic inequality, retarded economic growth, and disruptive patterns of booms and busts, not to mention the undermining the moral fabric of the people in the economy. So let's start by revisiting the proper definition of inflation. Now, why start with a definition? Proper definitions are essential for understanding anything. The purpose of defining any concept is to differentiate it from other concepts. And such a differentiation will illuminate the unique identity of the concept that we want to understand. And such identification requires capturing the essential, most fundamental characteristics of the concept that we're considering. For example, we define man as the rational animal because the rational faculty is what most fundamentally differentiates human beings from all other animals. Now, according to my Oxford English Dictionary, the OED, dated 2002, inflation is defined as a, quote, undue increase in the quantity of money circulating in relation to the goods available for purchase, unquote. Now, undue implies something improper, inappropriate, or unjust. I think the OED definition actually is pretty close to the mark, and I'm going to refine it a little later. But this definition is much different from the definition that the Fed now uses 20 years after that dictionary was published. Today, the Fed and most other economists say inflation is just an unwanted increase in consumer prices. Now, you can speculate why the Fed uses that standard, and I'm not going to do that today, but let's just look now at how useless that definition is. If we define inflation simply as an increase in consumer prices, then anything that increases consumer prices would have to be considered a cause of inflation. If I define inflation as a price increase, I could say that anything that causes prices to rise, such as like one-time product shortages or something, is an example of inflation. That's why you often hear politicians and economists blame inflation on things like supply chain disruptions, or on the pandemic, or on natural disasters. So if inflation is just a price increase, then I could blame the recent egg inflation on price gouging farmers, even though it was primarily caused by the deaths of millions of chickens due to bird flu. Or I could apply inflation to any price that went up, whether it was temporary or long-term, or to price increases on any or all goods over any period of time, even though real inflation as an economic phenomenon is always associated with rising prices of all goods or nearly all goods over a very long period. So my point is that including any and all price increases under the category of inflation really does throw us off the scent and confuses our thinking. To illustrate this problem, consider a doctor who has a sick patient and the sick patient has a fever, and the doctor prescribes a treatment that simply reduces the patient's temperature. Does the diagnosis of fever define the patient's condition in any useful way? What's the cause of the fever? Is it caused by temporary dehydration or a common cold or something serious like cancer or a deadly pathogen? Defining the patient's condition as, quote, a fever is obviously not helpful in defining his problem or prescribing treatment. The fever is just one symptom of a more fundamental condition that caused the fever. Now, in the same way, in the case of inflation, if we focus only on rising consumer prices, we will not identify the most fundamental difference between rising prices caused by inflation and rising prices caused by storms or shortages or spontaneous surges in demand. So we need to think in more fundamental terms. The most fundamental cause of a significant and prolonged increase in all prices is a large and prolonged increase in economy-wide demand. A rise in, quote, demand is just a fancy way of saying that everyone spends a lot more each year on all goods and services, and that this trend continues for years. Now, when people are spending a lot more over a long period, it can only be due to the fact that they have a lot more money to spend. Since we know that all money is created in commercial banks, this means too much money was created in the banks because that is where all new money originates. So now there is a myth that politicians like to trot out that widespread price increases are caused by product shortages. And a recent example was the Biden administration blaming rising prices on product shortages due to the Ukraine war or on supply chain disruptions caused by the pandemic, which nobody could have foreseen, so they say, and therefore it's not their fault. Now that's convenient because it allows them to blame something other than themselves for the rising prices. And I want to demonstrate why it cannot be true that shortages of goods can cause a rise in all or nearly all prices over a long time, over a long period. And I believe that once you see this, it'll be evident to you also that rising consumer prices over a long period are never caused by insufficient production of consumer goods. Okay, now I'm going to offer you now a sample equation. Don't panic. Don't be afraid of it. It's really easy. Take a look at that. Now, let's imagine an economy that spends $15 trillion per year on consumer goods. $15 trillion. And we can further imagine an average basket of goods that each consumer buys, consisting of some quantity of food and clothing and shelter and transportation, so on. And let's assume we know the total number of such baskets of goods that our consumers buy over a year. And let's say that number, the number of baskets they buy, is 300 million, standard baskets of goods. So if we want to know the average price of this standard basket of goods, we can divide the total amount of money our consumers spend on those goods and divide that spending by the number of baskets sold. That's the equation on the top of the slide there. Okay? Now, in a typical year, if the population buys 300 million standard baskets and spends a total of $15 trillion to do that, to buy them, this must mean that the average basket sold for $50,000. That's just 15 trillion divided by 300 million, that's 50,000, okay? Now, suppose over the following year after the typical year, or any period after that, really, the average price of the standard basket goes up 50%. And we want to know why, okay? Now, is this caused by an increase in D, the total spending, or is it caused by a decrease in S, the number of baskets sold? If you look at the equation, it can only be caused by one or the other or some combination, okay? But those are the only two factors that can control the average price of this basket of goods sold, all right? All right, now we are experimenting here to see if this price increase can be caused by product shortages. So what we're going to do is keep the total amount of money spent, that's the total demand, of $15 trillion constant. We're going to freeze that. And when you do that, you immediately see that the only way the average price could go up by 50% from 50,000 to 75,000 would be if the quantity of goods, the number of baskets sold, declined to 200 million. Okay. But now the question is, does this happen in reality? If it really happened that people who were consuming 300 million baskets of goods in 1 year now start to consume only 200 million of the same baskets of the same goods, that is 33% less food, clothing, fuel, shelter, and so forth. And if this happened, do you think you would notice a dramatic difference in the country's wealth? If you cut the goods and services sold by 1/3, that would be wiping out 1/3 of the food and clothing and shelter and transportation consumed. And under those conditions, you would see obvious mass malnourishment, poverty, and death, worse than the most severe depression we've ever seen. Such a decline in consumption would be cataclysmic, probably worse than a nuclear war. Okay, now let's apply this logic to economies in countries that do, in fact, have high consumer price inflation, such as Turkey and Argentina, where the average annual price increases is 50% to 100%. Now, these countries are struggling economically, but the consumer goods are still there. So just by looking at this simple equation and observing that that the average prices are, in fact, the ratio of demand to supply, you quickly conclude that the price increases we are seeing today must be caused by an increase in demand or the total amount of money spent rather than a decrease in the supply of goods. You look at countries with big inflation rates, and there's certainly no wipeout of material civilization going on. Now, I didn't have time to create the chart, but you could also see this in a more subtle way in the nominal GDP versus real GDP statistics. Nominal GDP, which is a measure of overall spending, has been growing at a rate of about 10% annually since 2020. Real GDP, a measure of real goods and services, real stuff, real quantity of stuff consumed, is growing at about 2.5%. Now, the difference between these two numbers is due solely to price increases. But there is still solid positive real growth. So I ask you, where are the product shortages? The answer is there are no product shortages. They're just higher prices. All right, to summarize this point, price increases due to shortages are not the same thing as price increases caused by expansion of the quantity of money. If we slap the name inflation on any price increase and do not identify its underlying cause, we would have to conclude that all kinds of temporary or unrelated factors are to blame for inflation, all of which would render our understanding of inflation meaningless. Now, here is the best definition of inflation I have found, with all credit to Professor George Reisman, who explains inflation in detail in his book, Capitalism. I heartily recommend reading this entire chapter. It's chapter 7 on price controls and shortages, which includes a thorough discussion of inflation, which I cannot do justice to in this brief presentation today. But he says inflation is not rising prices, but it's an unduly large increase in the quantity of money caused almost invariably by the government. In fact, a good definition of inflation is an increase in the quantity of money caused by government. All right. Now, an increase in the quantity of money caused by government brings not only an increase in consumer prices, but many other adverse effects as well, some of which are hard to detect in the early stages of inflation. Here are some of those consequences outlined by Henry Hazlitt. Inflation discourages all prudence and thrift. It encourages squandering, gambling, and reckless waste. It often makes it more profitable to speculate than to produce. It tears apart the whole fabric of stable economic relationships. Its inexcusable injustices drive men toward desperate remedies. It plants the seeds of fascism and communism. It leads men to demand totalitarian controls. It ends invariably in bitter dissolution and collapse. Now, other leading consequences of inflation that are implied in Hazlitt's statement here are asset bubbles, unjust wealth redistribution, something the Austrians call malinvestment, and slow economic growth. These are all serious consequences of excessive money creation, so they all must be included, along with consumer prices, under the concept we call inflation. But in fighting inflation, quote unquote, the Fed ignores these things. They're focused only on damping down consumer prices by suppressing the economy with higher interest rates. They are equivalent to the doctor who wants to treat his sick patient who has, among other symptoms, a fever by throwing him into an ice cold bath to get the fever down. In reducing his fever, you might kill the patient, and you will not be addressing the cause or the other symptoms. This is almost literally what the Fed is doing today by abruptly raising short-term interest rates after driving short-term rates to near zero during the last decade. Now, fortunately, market economies are remarkably resilient. So I don't think the patient is going to die. I don't think the economy is going to die, but the Fed's remedy is indeed harmful to economic production. All right, now, not all money creation should be called inflation, because money creation can be, I'm checking my time here. I'm good. Because money creation can be beneficial or detrimental, benign or malignant, or good or bad. Good money creation promotes economic growth, and it's not inflationary. Good money creation results in sound money, or money that reliably retains its value in commerce. And as we've said, sound money is essential both to economic progress and to overall human flourishing. I've got a couple of great quotes here. The first from the economist Richard Werner. And I'm going to read one first and then refer to this one on the screen. He says, when bank credit, or money creation, is used for productive investments, such as the implementation of new technologies, measures to increase productivity, or the creation of new goods and services whose value is higher than the mere sum of their inputs, thus adding value, then such new money creation, which always happens when banks grant credit, will not result in any form of overall inflation, neither consumer price inflation nor asset price inflation. Credit creation for GDP transactions that increases the amount of goods and services available generates income streams that can service and repay the new debt created, which is thus sustainable. It is also non-inflationary since increases in purchasing power will be met by an increased offering in goods and services or their value. So Werner describes here productive money creation, but there's also such a thing as unproductive money creation that does not care about offsetting new dollars with new production. Over the long run, unproductive money creation can only occur under government influence, and it is usually about vote getting and cronyism or some kind of collectivist wealth redistribution system, and it always revolves around keeping the entrenched politicians and bureaucrats in power. Okay, so at this point, I hope it's clear why the Fed's narrow definition of inflation as mere price increases is so detrimental to understanding. As Professor Riesman has said, inflation is an increase in the quantity of money caused by government action, and it is all money creation mostly all money creation of the bad sort. Now, my monitor is not working today, so I'm going to pause here and ask Daniel if we have any comments or chats.
We have a super chat from Dwayne for $5. Thank you so much. And also a super chat from Bonnie for $2. She says, this is crucial. I hope some see it when I share it. So thank you also for sharing it, Bonnie.
Bonnie, I couldn't thank you enough for that. Thank you, Dwayne, for the thoughts and for the contribution as well. Thank you, and thank you for sharing this if you do, because I'd be grateful, because this is my mission. All right. Now I want to get into a somewhat detailed example, but I think it's going to be relevant and interesting on bad money creation. And that is the Fed's episode of quantitative easing. which really well illustrates what bad money creation is. Now, the Fed's program of quantitative easing, or QE, from 2010 to 2022 was unique in economic history. The Fed would never say its policies caused, quote, inflation, because inflation to them is only consumer price increases. So let's talk about what happened under those years of QE, which was a massive experiment of government money creation. Here's sort of a map of what happened to QE. This graph shows that the Fed's total assets over time, in a little over a decade, went from under $1 trillion to nearly $9 trillion. Now, that's a good measure of the pace and extent of their intervention, because these assets that they buy are treasury bonds, almost all treasury bonds and mortgage-backed bonds. And every time they purchase these bonds, they create new money in the banking system, as I'll explain shortly. The Fed's progressive program of QE is really a good example for two reasons. First, it is an example of inflation as I define it, as I think it should be defined: money creation caused by government action. Money creation in this case was done on such a vast scale and had so many obvious observable effects that it kind of serves as a laboratory lesson on bad money creation. But another reason, and equally important, the QE era reinforces the importance of using proper definitions, which are essential to accurate understanding. Because even though the Fed was itself wholly responsible for QE and what happened, they were completely surprised when it eventually resulted in inflation, by their definition, which was consumer price increases. Remember in 2021, how they said price increases were merely temporary or transitory and were caused by pandemic-related supply shortages. Because they did not define inflation correctly, they could not see that inflation had been going on right under their very noses for over a decade. Then they were surprised by a massive increase in consumer prices. So failure to identify inflation as an increase in the quantity of money permitted the Fed to think, or at least to claim, that their QE program was non-inflation, just like our quack doctor who might claim the patient was not really sick if he didn't have a fever. Now, incidentally, QE from 2010 to 2020 was accompanied by increasing consumer prices on the order of about 2% per year. So here we can see that the Fed further defined, quote, inflation as an increase in consumer prices above their target of 2%. So in their view, inflation by their definition is not really inflation unless it rises above 2% a year. Make sense of that. I mean, I would point out that the ideal rate of allegedly, this so-called ideal rate of allegedly non-inflationary price increases reduces your purchasing power by about 60% over 30 years. So if you're starting to become suspicious of the Fed's public smokescreen on inflation, join my little club. Anyway, back to QE as an example of bad money creation. There were 4 episodes of QE that I just showed there: QE 1, 2, 3, and pandemic QE, which some people also call QE 4. And during each of these periods, the Fed engaged in specific activities in the bond market that created new money in the form of deposits in commercial banks. Now, here is a statement of their motive, which Ben Bernanke wrote in the Washington Post back in 2010. The Fed's motive here is supposedly a kind of trickle-down wealth effect that was supposed to stimulate economic activity. And you can tell from Bernanke's language here that he knew he would be inflating asset prices. Incomes and profits talks about higher stock prices. But somehow this is supposed to stimulate job creation and capital investment instead of just making the rich more wealthy. So I want to review now the actual mechanics of quantitative easing to see how it creates new money, to see who gets the money, and then judge whether this was good money or bad money creation. Okay, in step one, the Fed contacts a private bond owner, for example, a pension fund, and offers to buy a bond at a profit above its original cost. The bond owner agrees to the transaction. The bond owner, like all investors, of course, has an account at a commercial bank. So in step two, the Fed pays for the bond by instructing the bond owner's bank to increase his bank account by the amount of the purchase. At this point, new money is created. Then in step three, which is really simultaneous with step two, the Fed credits the bank with new cash reserves held in the bank's account at the Fed. That is designed to compensate the bank for the new liability that it has taken on by giving the bond seller new money. So now let's look at the result of this transaction from each party's point of view. The bond seller, in this case, say a pension fund, has new money in the form of a bank account. This money did not exist before the transaction. And we're shortly going to delve into whether this is good money creation or bad. Obviously, you know where I'm going with it. Okay, from the commercial bank standpoint, the commercial bank now has new reserves held on account at the Fed to offset its new deposit liability to the investor. If the investor withdraws the cash, the commercial bank is fully covered by cash reserves that are going to transfer with the deposit when it's moved. So the bank cannot be harmed by this particular transaction. The Federal Reserve Bank now owns a bond as well as a new asset. As a new asset. And it has a new liability to the commercial bank in the form of cash reserves held on deposit at the Fed for the bank. Okay, the investor who sold the bond now owns a new bank deposit. That's new money. And since there are now fewer bonds in the market than before the transaction, because the Fed owns the bond and took it out of the market, the investor has to pay a higher price for a replacement investment. Since the investor's job is to invest, he takes this new money and reinvests it in a new treasury bond, or perhaps into a corporate bond or into shares of stock. Because this new money creates additional demand for bonds, for the existing bonds, those prices rise. And because bond prices and interest rates are inversely related, interest rates are driven down as bond prices go up. Now, as this QE process continues over many years with trillions of dollars, investors are virtually forced to substitute riskier assets for safer bonds. That causes yields of even higher risk and speculative investments to come down to what is usually associated with a safer investment grade yield. Investors start to view speculative schemes as everyday investment opportunities. So capital gravitates to risky investments or ventures. Risk is thus distorted, and the calculation of risk becomes more difficult. As interest rates decline to near zero, normal low-risk saving for the average person becomes impossible. Now, what was the effect of this operation on consumer prices? Not much yet, because the new money was not spent on consumer goods. The investor, an institution or an individual with a mandate to invest, spends his money on a new investment, not on consumer goods or on any of the many other items that are counted in the gross domestic product or GDP. Wherever any new money gets spent, that is where the prices have to rise. The money created under QE was given to people who had to spend it on investment assets. And this continual flow of new money drove up their prices and put downward pressure on interest rates. Because money from investments is very slow to escape the investment universe, maturing bonds and capital gains are reinvested into more stocks and more bonds. And as long as money keeps coming into the investment markets, investment demand rises and the prices of stocks and bonds must go up. Now, QE also drove up the price of houses because the Fed bought not only treasuries, but also mortgage-backed bonds, lowering the interest rate on mortgages, which made mortgage rate payments cheaper, allowing buyers to pay higher prices for houses. But bond prices, stock prices, house prices do not show up in the consumer price index. So the Fed assumed there was no inflation. Amazingly, they were actually concerned about deflation. That was actually what their worry was. Now, what was the effect of this QE on the US Treasury? The Fed over these years acquired trillions of dollars of Treasury bonds. This meant that the Fed collected interest from the Treasury on those bonds. But then the Fed paid back that interest right back to the Treasury as a dividend. This practice means that the Treasury can borrow from the public, let the Fed buy this debt from the public, then get its interest payments back. The Treasury gets paid back the interest that it pays. This is roughly the same thing as free money to the Treasury. Imagine if you could borrow from rich relatives, call them your Uncle Jay and your Aunt Janet. And imagine that they charge you interest on your loan, but then return your interest payment right back to you. There would be no limit to what you'd want to borrow. It'd be like having no debt at all. Now, this procedure is called monetizing the national debt because it takes Treasury debt out of the market and replaces it with spendable money. The net result is new spendable money with no increase in the real debt. By our definition, that is pure inflation. Now, what was the effect on the commercial banks? The commercial banks got a whole load of new cash reserves, which they could use to meet withdrawals or as a cushion against bank runs. But they also had to operate in a marketplace dominated by the rising price of stocks and bonds. Now, banks will lend where and when they can make a profit. So when asset prices are rising, they will make loans that depend on rising asset prices. That was the lending policy of both Silicon Valley Bank and Republic Bank, which now have either failed or are on the brink of failure. So instead of promoting careful lending that would facilitate new production or efficiencies, as Richard Werner described, the Fed's QE encouraged banks to lend speculatively based on continual asset price increases. And in this way, the Fed induced the Fed's bubble created loan market tended to crowd out more productive bank lending. As Charlie Munger said, Warren Buffett's partner, show me the incentives and I'll show you the outcome. And the Fed gave all these perverse incentives to all these parties. Now, by the way, you can't blame the bankers for lending against rising asset prices for their speculative lending. They have to lend to the market as it is. And if the market is distorted by bad money creation, they still have to deal with the market as it is. Because if they can make a profit, they're going to lend. That's what they have to do. A key point here is that banks did not create on a relative basis much new money that went into GDP producing activities because they had no market incentive to do so. A transaction to buy or sell stocks is not recorded in the GDP. And because of the low credit creation related to GDP activities, both nominal and real GDP growth was sluggish, especially compared to the growth in asset prices and the growth in the money supply. And meanwhile, as asset prices went up, the investment market started to look more like a casino than anything else. Now, then finally, after years of feeding the financial markets, the Fed engaged in what I'm calling pandemic QE, in which the Fed and the Treasury collaborated to get new money into the hands of everyday citizens as well into the hands of the Wall Street investor class. Because the new money now went to consumers and was no longer, quote, trapped in the investment markets, pandemic QE did result in trillions of new money spent on consumer goods. So we predictably saw both ballooning nominal GDP and ballooning consumer prices. There was also plenty of new money left over for investment. So asset prices continued to soar. That's when we saw the birth of a new investor class, the Robin Hood investors, who took speculation in meme stocks to new heights. Now, who benefited from these ballooning asset prices? Obviously, those who already owned the assets, or those who were paid by those who owned the assets, like Wall Street brokers and traders. When those ballooning asset prices are monetized and spent, some of the proceeds are spent on yachts, vacations, or trophy ranches, but most of the spending is reinvested in the financial markets. Now, did these ballooning asset prices do anything for savers? Only if they already had assets and savings, like in a 401k plan, but not nearly to the extent as the wealthy benefit. And what about the 40% of our population that relies on their wage income and doesn't have any savings at all? Did they benefit? Well, these people found it impossible to save money in a world of near zero interest rates. What would have been an accumulation of savings over time for them through compound interest was transformed into asset price appreciation, which benefited the asset owners, diverting purchasing power away from people at the bottom of the income scale and toward those at the top. And how many new businesses were not formed because of the zombie companies that were kept alive through zero interest rates and that were eating up scarce labor and capital that should have been freed up for better use? So some final bullet points on QE. QE fostered unprecedented increases in asset prices beyond any historical comparison that I've seen. QE distorted the assessment of business risk, making sound investment calculations difficult. QE diverted investment from moderately risky to very risky ventures. QE diverted talented labor and intellectual talent into inflating industries where the money was flowing. QE suppressed savings, raised the cost of living, and undermined the savings mindset. QE encouraged a casino-like atmosphere in the investment markets. And by lowering interest rates, QE emboldened the government to borrow irresponsibly in order to spend more on projects that redistribute wealth but do not create it. Now, we could say a lot more, but I hope that helps you see how to analyze a pattern of bad money creation. You have to consider who gets the new money first, how they spend it, and what are the follow-on effects as the new money spreads through the economy. And this will show you give you an idea at least of how it distorts normal pricing signals, although it's always, I think, impossible to see through it completely. All right. Now, I have way too much material today, so let's pause now and reflect for questions and comments, either on my characterization of inflation or on the example of QE as bad money creation, which I consider synonymous with inflation itself. I wanted to move on and update the banking crisis and financial repression, but I can see that I'm not going to have time to do that. So let me pause and take any questions now. Thanks, Daniel.
We don't have any questions.
Okay, good. In that case, I'm going to take just a minute to talk about the regional banking crisis, because there are some interesting updates. Okay, so back on March 4th, I think, March 12th, I was able to easily foresee, and anyone could, I said that a potential run on the banking system was going to be contained by a new Fed program of monetizing assets, a new kind of QE. And only a few hours after I published that essay, the Treasury and the Fed jointly announced a new QE type facility in which the Fed agrees to lend a bank cash reserves equal to the full face value of all its assets, even though those assets might have declined in market value. And that assures that depositors can always get their money out of the bank. It was a logical thing to do for the Fed because I think anything short of that would have risked a nationwide bank panic. So the deposit failure problem, the problem of people not being able to get all their money out of the bank has been taken off the table by the Fed. And I remain pretty confident that no depositor in an American bank is going to lose money under the present government and the present regulatory regime. And as you can see in the quote at the bottom of the slide here, Warren Buffett agrees, although he's not right now investing in banks as he's done in the past, despite their lower stock prices. However, this is the interesting update. The deposit drain problem still needs to be solved because deposits continue to flow out of the smaller banks and into either the larger banks or into non-bank alternatives. And this chart shows the reason why. Now at the bottom, look at the difference between a typical interest rate that's being paid today on a bank deposit, that's in orange, and a 3-month treasury bill or a money market fund that invests in government securities, short-term securities. The difference between 0.4% and 4.5% is huge. On a $1 million deposit, that's $4,000 of annual income versus $45,000 of annual income. And that's too much not to notice. So deposits are going to continue to flow out of the banks until they raise their deposit rates. But when they do that, that will raise their costs and affect their profitability. So they may be slow to act, hoping enough depositors will stay despite the rate differential. Now, the problem the banks have in losing deposits is not that there is less money for the banks to lend, because remember, banks don't need deposits or cash reserves to create a loan. They do not lend out deposits and they do not lend out reserves. So if the pundits tell you that when banks lose deposits, they lose all the raw material for lending to others, that is false. However, loss of deposits can affect bank lending in a different way. Banks do need deposits because they need cash reserves. When deposits leave the bank and move to another bank, cash reserves also move. Now, why do banks need cash reserves? Banks need cash reserves to redeem cash withdrawals, and more importantly, to avoid a run on bank deposits. In other words, banks need an adequate proportion or ratio of cash reserves compared to their total deposits. If too many cash reserves leave the bank, further withdrawal of deposits can only be met by selling illiquid assets like loans and bonds. And as we saw in the SVB failure, banks may not be able to liquidate these assets in time or in the amount that they were purchased for, which means they cannot pay out all deposit withdrawals, which means bank failure. So the real potential risk to the economy is not the drain on bank deposits or on cash reserves, but on the lending activity of the banks, especially the regional banks, which play an important role in the economy by funding lots of real productive activity. And small and regional banks create much of the productive money that keeps the economy growing. According to this data here from Bianco Research, small banks account for 70% of commercial real estate loans, 40% of residential real estate, and about 1/3 of commercial and industrial loans. So they definitely, you would say, hit above their weight in terms of productive lending, and they're well qualified to do so because they know their regional markets very well. So I think the critical question is this deposit drain going to affect the bank's productive lending, the good money creation, that finances so much productive business activity? If that happens, you may see a credit contraction that results in business failures of legitimate and creditworthy businesses. That's known as a credit crunch. And if we actually get shrinkage in bank credit formation, that could usher in a severe economic downturn. But that might not happen. The jury's still out. Some credible analysis I saw in the Financial Times indicates that the banks continue to lend, although it is slowing down. And it appears they can afford to raise their deposit rates, which should do a lot to stop the slow motion deposit run that's now going on. Let's say it's slowing to a walk or a trot, maybe. Let's call it a deposit trot, not a run. So anyway, deposit flight due to depositors seeking higher rates might not be bad enough to put a severe crimp in lending. The bankers might be encouraged by the Fed's deposit guarantee to some extent. Plus, they're going to raise their deposit rates enough to become more competitive with the government's rates. And perhaps after a brief hiatus, they're going to resume their lending growth rate. So expect a slowdown in bank lending, but we have to keep our eye on this. Hopefully it won't be an outright reversal with negative growth. All right, now I am now out of time, and I had so much more. I don't know what the heck I was thinking, but I just want to say, if you have not done so, go out and get yourself some of that hot return. You can get it directly from the Treasury. You can buy it in a money market fund. You can buy brokered CDs through your broker that will give you on 3 months money 5% or better. Certainly well over 4%. So go get some of that money. Finally, just a quick shout out for me. I got a Fake Banks and Real Banks, which was an article I published a while ago. I got it published in Capitalism magazine under the Money and Banking heading. And so with that, I'm going to close and ask if there's any final comments. Thank you for listening. Anything else, Daniel?
No.
All right, everybody. I'll see you soon. It won't be, I was gone for 4 weeks. It won't be 4 weeks next time. And take care, be well, and live long and prosper.